Hello, so this is the topic where we're looking at the broader concept and the broader setting of corporate finance decision making. So what's kind of happening in the external environment? And the two main things are the markets, the financial markets. So obviously it's a plural. So the idea is to look at the sectors that combine to establish both short-term and long-term financial markets, and then also the institutions, and particularly the regulatory institutions that are the main focus of this topic. All right, so if we're talking about the financial markets and institutions, we're obviously talking about the financial system. That's really the nuts and bolts of it. And so it's worth thinking about, well, what is a system? So it's obviously not just a single entity, it's a whole cluster of entities. And that's important to recognise, because that means that not only will there be a cluster of separate entities within that one system, but more importantly, they kind of bounce off each other as well. So they're not all just sort of a simple linear line from the institution into, well, because it's a deregulated institution, there's no particular hierarchy, and therefore they're much more likely to kind of affect each other in ways that we'll never know. But what's important is therefore for any individual company to recognise its place within the industry and its place within the market. And those are two themes that we pick up on in the assessment task, because in that first assessment task we do look at and measure the functions of a particular entity within the system, how that entity would quantify its future prospects and the threats and opportunities that might be presented by competitors within the industry. So what this topic 4 is looking at is certainly relevant to what comes up in the first assessment task. Anyway, coming back to the learning objectives for this topic, is also, it relies to some extent on the economic theory of how the whole system revolves and how the whole system grows. Knowing that, all right, we're talking about a financial system, so what's kind of the lifeblood? What is the currency of the system? The answer is money, obviously. And therefore, with those flow of money, the system grinds to a halt if money is not flowing. And so then you think, well, where does it all start? Well, it starts with those that have excess money, because even if it's just us putting money into our at-call account, because, you know, we're trying to save up for something, that is still a cog within the biggest system where you have lots of entities, large and small, doing the same thing. So the money comes from entities, people, institutions, feeding into the system, pouring in that cash, that liquidity. So that's where the money comes from. And so that's the source of the cash, the lifeblood. And then the application of that money or those funds goes to what technically in economic terms is the deficit units. So those are the entities, again, you know, for those of us lucky enough to get a mortgage, then we're going to be a deficit unit at that point in time, because we're not going to have, you know, a cool $500,000 sitting around. So we need to borrow in order to purchase a home, and then we pay that back. So we would be classed as a deficit unit. Companies that are growing and successful will always be deficit units. And that's why that sort of common rule that some people say, well, you know, you should never borrow, it's not good, you don't want to have debt. That's not true at all. For a corporate entity, their lifeblood is debt, and it's well managed. That can be huge. Well, that really is the reality. To grow and be successful and maximise shareholder wealth, there must be debt within the capital structure. It's all about how well that's managed and so on. So coming back to the cash flow and the funds, so that's the lifeblood. So without that continuous flow of cash, the system would grind to a halt. And that's to some extent what we witnessed with the global financial crisis. So it was a massive global crisis for so many reasons, but one of the dimensions of that crisis was that the short-term credit markets dried up. So no one was feeding money into those credit markets because no one had confidence in that segment of the market. So that dried up finance. And for a lot of companies that were reliant on short-term refunding of their borrowing needs, some of those companies actually fell into bankruptcy because the cash flow, the lifeblood stopped, so they couldn't survive. So it can become that critical. So we have that. And then we can come down and look at the financial markets, and they can kind of be sliced and diced in different ways. And so again, let me backtrack and say, all right, well, we've sort of defined a financial system. So what's a financial market? And the answer is, well, like any market, you've got buyers and sellers. So as long as you've got one buyer and one seller, an extreme example, you've got a market. And so it doesn't have to have a physical presence. And of course, financial markets these days mostly don't. So that the market is just a point where the transaction occurs. Someone sells, someone buys, and you have that exchange of goods and funds, and that becomes a transaction, and that's the market in operation. So therefore, it can be described in different ways. So in terms of the financial market particularly, we can look at public and private, and this is particularly relevant for companies, incorporated entities. So because as we've already acknowledged, companies are always hungry for cash, and that's a good thing. It's not a bad thing, it's a good thing, because that's how they grow and that's how they maximise wealth. So because they're hungry for cash, they need always to be feeding that need by getting cash coming in ahead of when they need it. So it's critically important for the finance team to be way ahead of the game in terms of anticipation of when more cash will be needed, well before it's actually dependent, an operation is dependent on it. So they go into the markets to raise cash. Now again, in the Australian context particularly, because the super funds are often cash rich, they're looking for opportunities. So similarly, they have to kind of manage their asset and liability sides of their balance sheet. So they're looking always to look for opportunities, seize opportunities, and maximise their values as well. Because even though some within the superannuation industry aren't profit driven, they still have to have healthy revenue streams. And of course, others in the retail sector are profit driven. So the ability to maintain a good cash inflow is relevant across the board. So anyway, coming back to getting cash from the markets, if a company needs cash for a new investment project, it can either go into the public market, so it can issue more shares, or it can issue debt into the public market. The downside of that is they have to have a prospectus. So regulatory controls say if you are going to borrow from the broad public area of the market, you must have a prospectus. And the basic logic is, well, you're going to be capturing, potentially you're going to be capturing a naive investor. So you've got to give them the full explanation about what you're doing, why, what you expect to happen, and so on. So from a company's point of view, that can get pretty expensive. So sometimes companies will go to the private end of the market, which is where they pitch that borrowing deal to institutional, particularly the super funds within the Australian market. So public or private, that's one way, that's one dimension of the two parts of the market that a company can look at in terms of borrowing. Another dissection of the market could be primary and secondary. So when a company floats for the first time, that's in the primary market. If the company issues debt, a new tranche of debt, that will be the primary market. So basically anything that's new is a primary market security. Anything that's sold second-hand is in the secondary part of the market. So that's the basic dissection of those two parts of the market. Now, financial institutions, so that's a big focus of this topic. And financial institutions, again for Australia, it's the big banks. They're the most sort of recognisable and they're the economic powerhouses. Realistically. Now, for a company, going back to the topic of risk and return, we know that, okay, companies will maximise returns based on the risk, but we haven't really drilled down into, but what type of risk? Because there are some types of risk that the company needs to shed. It doesn't want certain categories of risk. So it only wants to maximise a particular type of risk. So what that means for the financial institutions is they become the purchasers of risk. So it works in a kind of a similar way to an insurance company, where as an individual, you can't afford to bear the economic exposure that a lack of insurance would have for you. So if you don't insure your car, you potentially could be up for millions of dollars if you run into someone's really expensive vehicle. So therefore you take out insurance. So it's not exactly the same, but it's a similar concept in terms of the big financial institutions. So they purchase the risk from a company, the risk that the company doesn't want to bear. So it hides that off and it sells that off to the financial institutions. But it costs because they're selling that to the financial institutions. And again, depending on the type of security or instrument that is being captured under that deal, that might be a one-off or it might be something that rolls over. But the essence of it is that's how companies mitigate, how they manage their risk and how they shed the risk that they don't want to retain, but they keep the risk that they're happy. And generally the financial risk, that's the job of the finance team. They manage that risk, and that's the risk that can really make serious money for the company. But other risks, such as operational risks and so on, might be things they want to get rid of. And so they use the financial markets and financial institutions in order to transfer that risk onto their shoulders. Then the question becomes, well, what happens to the risk? Well, it never disappears. It's a bit like, the water cycle, it's always there. So it's the same deal for risk. But the thing about the institutions is that they have broad shoulders. They're big, large entities. They've got big capital support to them. They've got deep pockets. And therefore they can afford to take on this risk because they have a kind of spread, a diversified risk within their particular profile in their particular portfolio. So that's how they can afford to take on the risk. Now, we also look at international finance, and the question then is, well, from what we've looked at, it's hard enough being in the domestic environment. You think there's so many challenges here. Why would you go offshore and sort of add to the complication of it? Because you've got enough to deal with within your domestic market. And that's true. However, the thing to consider is diversification again. So basically, it's because of diversification. And so going offshore, as much as it adds in the risk of currency, so the downside, well, it could also be an upside, but the additional layer of risk that you incur if you go into the international sector is you're going to have currency risk that you would not have had if you stayed within your home market environment. So that's an additional risk that you have to manage, and certainly that becomes part of the finance team's responsibility. But there's a lot to be gained by going into the international markets. As I said, currency risk, even though most people would think of it as sort of the downside risk, if you're generating cash flows in an overseas currency and the Australian dollar weakens, then that becomes an additional bonus because you're coming back and purchasing a weaker currency. So when those funds are repatriated, you end up getting more money in terms of Australian dollars than you might otherwise have expected. So it can work in either direction. But the more clear benefit is you're moving into new markets, new investment opportunities and so on. So the international sector, for companies in 2018, it's a given that you've got to go offshore, you've got to go into the international environment, because generally there's a lot more to be gained than lost. So the cost-benefit analysis is clearly endorsing the idea of doing it and moving into that environment. Finally, we touch on the efficient markets hypothesis, and that theorem is that the markets are efficient. And so this is coming back to what I mentioned in the very first topic, where everything hinges on the assumption that the market's efficient. So in this topic we say, yeah, but is it? Is the evidence to say yes it is or it's not? And before we can kind of come to that conclusion, we have to sort of get our minds around, well, what is being proposed here? And so the theorem says, well, we're not proposing that it's absolutely efficient, it's relative efficiency. So there's 3 levels: strong form, semi-strong and weak form, and there's different tests that apply to each level of efficiency. So long story short, we learn about the theory of what those 3 levels are. We learn about, well, how do you test for it? And then thirdly, what's the conclusion? I mean, there's been many studies already done. There's a good body of empirical evidence. So what's the conclusion? You know, is it generally efficient or is it not? And the conclusion is actually quite interesting, but you'll have to wait until we cover that. You can read ahead anyway, but it's quite a hot debate about what the level actually is. Finally, in terms of what can go wrong, insider trading is the absolute bugbear of an efficient market. So if you have extensive insider trading, even a bit of insider trading according to theory, kind of blows the idea that you've got strong form efficiency, because strong form efficiency says, well, if that exists, it's mutually exclusive. If you've got strong form efficiency, you don't get insider trading, or you certainly don't have successful insider trading. We know that's not the case. We know that that's sort of many would say the tip of the iceberg are those that are caught. The really clever ones never get caught, and therefore they keep doing it. So insider trading, again, that's kind of the case in point. And I have got a case study that I'll provide a link to. So if you're interested, you can kind of do further reading on this and look at the example where it's astonishing, the things that people do in large incorporated entities. And as someone commenting on a recent successful prosecution, he said exactly that. He said, look, the really good ones will never get caught. It's only the silly ones that do. Anyway, we'll come back to that when we look at the detail. So that's the end of this topic. Thank you.